Perfect. All right, so we're going to go ahead and get started. It looks like we have a great turnout here today. I'm very excited today to talk about our 2015 investment forecast and 2014 Q4 review. This is Stacy Francis. I'm the President and CEO of Francis Financial, and as you know, Francis Financial is a wealth management boutique. We specialize in working with individuals going through transition. We work with many couples going through transition, and that could be transition to retirement. It could be also transition from corporate America to starting their own business, typically complex financial needs. And also, we have a specialty of working with women, and these women are very special women who might have gone through divorce or unfortunately have lost a spouse. All of the clients that we work with need additional hand-holding, and their finances are not necessarily straightforward because their life is changing. So if you know someone who we can help, please do let us know. But today we're going to be talking about investments, and this is one of my favorite topics to speak about. And today we have a lot of information to get through because there's a lot going on in the world. So with that, we're going to go ahead and get started with just the overall broad recap of the economy. First, it will be our market review, and then secondly, we'll dive into our investment outlook and portfolio positioning based on what's happening in the world today, and also based on where we expect the world and the economy to be going. So let's start with this. So our market review. Q4 was a very, very busy time, and what we've done here, we've included all of the different asset classes, the typical asset classes that you would be interested in, their returns for the fourth quarter as well as that year-to-date time period. So that would be from January 1st, 2014 through the end of September. So that gives you a little bit of information. These are all based on indexes, and I can give you the list of indexes, but we have, for example, investment-grade bonds. Those are that information is based on the Barclays Capital U.S. Aggregate Bond Index. We have then domestic stocks here as well. That's based on the SP 500. Small company stocks based on the Russell 2000. So we have all of these indexes that are giving us this information. So overall, if you take a look at the returns, you'll see some trends. And the first trend is that large cap stocks actually experienced an unusually long-lasting period of gains. In fact, going back to 1920, we've only had 3 time periods in history where we've seen such long gains, particularly in the large cap area. So this is something that we were surprised by, essentially the robust returns that we did see from large cap U.S. stocks. Now in the international arena, developed international stocks actually lost money. Developed international such as Germany, China, the UK, Canada, they actually lost about 6%. Emerging markets, they fared a little better. They essentially were flat. And essentially these returns are reflecting the fact that both of these large parts of the world were facing a big headwind, numerous headwinds, and one of those actually is the strengthening of the U.S. dollar. We've seen dramatic U.S. dollar strengthening over the last several months, and that is actually a strategy or something that we expect going forward. Contrary to expectations, the actual 10-year Treasury declined further and bond prices rose. So you'll see that investment-grade bonds, the index was up about 6% for the year, and municipal bonds also fared significantly well. However, other areas such as credit-sensitive sectors and also our high-yield and floating-rate loans, they lagged, and that is something that we expect to have a turnaround going forward. And we'll talk a little bit more about that. So let's talk about the dollar. So we know that the dollar's rally, the strengthening of the U.S. dollar, is very good for your travel plans. So if you have plans to visit the UK like I do, in 3 weeks I'm going to be going over to visit our family in London, it'll be wonderful for me because my U.S. dollar is going to be able to buy more when I go and travel visiting the UK. However, unfortunately, this has created some headwind for some of these economies. The stronger dollar actually reduces returns on investments that are denominated in those foreign currencies. So as such, you'll see that the the developed international as well as the emerging markets did not do as well last year. Essentially, the strong rise of the dollar against the broad range of currencies was a key development. In December, actually, the U.S. dollar index hit its highest level since March 2006, and it actually appreciated 12% for the year. The dollar's strength was likely a function of the superior growth characteristics of the U.S. economy. Also relatively high Treasury yields compared to government bonds in other developed countries, and expectations that the Federal Reserve is going to eventually start rising rates soon, which we expect as well. All of these factors have attracted a lot of investors to the U.S., putting upward pressure on the dollar. So what does this mean about the U.S. dollar? And what does this mean about U.S. stocks? Well, overall, what we saw this last year is that U.S. stocks continued their streak of outperformance over foreign stocks, essentially doing much better than foreign stocks. And however, we expect that foreign stocks will be the winners in the long run. We expect foreign stocks to actually outperform going forward. Why is that? Well, you can see here that large cap stocks had a very strong year. In fact, the S&P 500 gained 14%. This chart starts back here with the actual U.S. S&P 500 starting back in January 2014, and you'll see its ascent throughout the year. And it's quite a volatile ascent, but here we are sitting. And since 1945, there have actually only been 3 other periods where the market has had a longer streak of positive performance without at least having one 10% down correction. That means that no other time, other than 3 other time periods, do we have such a high ascent of positive returns without having a loss of 10% or more during that time period. The length of the average market rally without a 10% correction is actually 346 days, whereas the current rally stands at 1,172 days and counting. The historic average gain during these rallies is 38%. Currently, our gain is 88%. So these are all reasons why we expect that the unbelievable rally that we have had in stocks is not going to continue at the same pace. In fact, we were quite surprised at the returns we even saw last year because of the statistics that this is, again, a new time in history. Outside of the U.S. large caps, the major and most major stock markets actually fared pretty poorly in 2014. For example, developed international stocks lost 5%, and emerging market stocks dropped 2%. These returns reflect a significant headwind represented by the strengthening of the U.S. dollar, which actually detracted 10% from developed international dollar-based returns compared to their local currency returns, and 7% from emerging markets. Putting things in perspective and broader context, over the past 2 years, the S&P 500 has outperformed the developed international index by 11.2 percentage points, beating the emerging market index by an additional 20.7%. This is a huge magnitude of outperformance for the U.S. versus foreign stocks, and it's very rare. This having occurred less than 20% of the time historically. So, and we're going to dive a little bit into this a little bit more, because what we have seen is that overall, we do not expect, as I mentioned, the U.S. stock market to continue this type of pace. And we were looking at it from another way here in this chart. So this chart we've put together, it's the S&P 500 GAAP PE ratio. And this line across the middle shows you the average PE ratio going back all the way till 1925. You'll see that there are times where the PE ratio, essentially potentially the stock market was overvalued, and then you'll see other times where it's below, so it's below the average PE ratio. I'm going to bring you up to current time. We're going to move from 1925 all the way up to the year 2000, and we're going to see our first bubble. I'm sure that some of you remember this, the first bubble, and then we had a crash, and then we had another bubble shortly after, another crash, and finally, of course, everybody remembers 2008. Where are we at? Well, we're right here. And what's important to note is that we are above our average PE ratio. That is something that we expect that this will come back down as U.S. stocks start to slow in their overall growth. Now, if you think that large caps are overvalued, interestingly enough, small caps are even more so overvalued relative to large cap stocks. Within the U.S., we actually view small caps as even more overvalued than large caps, with larger downside risk in the event of a major economic shock to the market. This is why we actually are underweighted in small cap stocks. Going forward, our strategy for 2015, going forward for this year, we will continue to remain underweighted to small cap stocks. Where we've taken that money and invested it instead is in large company stocks. So that was actually one of the wonderful positives that we had to our portfolio. We have very little exposure to small cap stocks in 2014, and as such, we really didn't feel any of the losses that small caps had at that time. Going forward, we remain committed to our international exposure. After another year in which U.S. stocks outperformed other markets, it's essentially been 4 out of the 5 past years that U.S. stocks have outperformed international markets. We're definitely starting to hear more people question the benefit of, should you be even investing outside of the United States? And actually, it's a very important question. We definitely acknowledge that owning foreign stocks has been a very unsatisfying experience for you and actually for us as well over the last couple of years. More so even, given the current economic and geopolitical forces, it definitely can appear likely that the trend of U.S. outperforming international is going to continue. But there's a few things to remember. And the first key point is to remember that equity markets, stock markets, and asset classes in general, they go through cycles. And it's definitely not a smart thing to extrapolate recent performance trends too far into the future. Furthermore, investors can definitely suffer from extreme overconfidence, believing that because we've seen U.S. stocks outperform international, that it will always be that way going forward. Now, this is a chart that I wanted to share with you because it shows a time period when that was exactly the opposite. So if you look to the right, you'll see that we included the time period, the cycle from 2002 to 2007. International stocks, you'll see in gray here, emerging markets, a 29% return. Right next to that, you'll see developed international over that time period, a 14.8% return, and this is each year. And then finally, we have U.S. stocks trailing significantly at a 6.1% return. Essentially, international stocks trumped U.S. stocks by a very wide margin, and even emerging markets did so even better. In fact, emerging markets outperformed the SP 500 by more than 20 percentage points each year. And what was interesting is that after this time period, we actually heard the opposite. We heard many people, many individuals, clients asking about having more exposure to international, not less. So let's talk a little bit about what's happened going back all the way till 1970. So we put this chart together. A lot of work went into showing you how did each of the markets do during these time periods from 1970 all the way up through till present. And what you'll see here is that because markets move in cycles, there's always going to be a period when global diversification, that means investing internationally, appear to not work. But in our view as long-term investors, the case for global investing remains compelling and extends far beyond the simple matter of just capturing returns as the market leaders rotate. The thinking behind global diversification is actually pretty straightforward. Equity markets, stock markets around the world at any given point are at different stages of their economic and market cycle. And at any given point, one particular market can and definitely will outperform the others. However, consistently predicting which market will outperform, and more importantly, getting in at the exact right timing, it's nearly impossible. So what this chart shows you is the trailing 12-month return differential of U.S. versus non-U.S. stocks going all the way back to 1970, as I mentioned. Periods above the line, so the periods above this line, are showing you when U.S. stocks outperformed non-U.S. stocks. Now the period below the line shows you when non-U.S. international stocks outperformed. As you can see, the performance tends to move in cycles. And periods of outperformance can last for extended periods of time, and then it reverts. So a good example here, we had a strong period of outperformance in the 90s of U.S. stocks, and then we saw international outperforming. Came on back, and then we started to see U.S. stocks again outperforming, and then a long period, a very long period of international stock outperformance. By concentrating your exposure in only one market, you essentially run the risk of that market undergoing a downturn for an extended period of time. It could have a lasting negative impact on your portfolio. And that's why diversification is so key. It enables us to create portfolios that perform reasonably well across a very wide spectrum of scenarios and outcomes. And our hope, what we're looking for, is that during certain times, asset classes a piece of the portfolio will outperform, and another piece of the portfolio may underperform. Let's take a look at the long-term case, because you can see going back to 1970 that it's been very wise to own both international and U.S. But is that still the case going forward? So let's go back and assume that we had a portfolio that was just in the SP 500 versus a portfolio that had both U.S. as well as international, and that's called our global equity portfolio. The diversified global equity allocation should produce better long-term risk-adjusted returns than any single country, like owning the U.S. only, held in isolation. And actually what you're seeing here is that historically this is actually what has happened. So going back to 1970, we look at the rolling 10-year period returns. And there you'll see the global equity portfolio generated returns consistently of 12.5% each year. That is that beautiful green line that we have here today. It beat the S&P 500's average return significantly. The average return for the S&P 500 was only 11.3%. And what's interesting is that the global portfolio actually beat the S&P 500 portfolio in 71% of the rolling 10-year periods. This is, again, going all the way back till 1970. So this is why diversification, again, consistently owning a variety of asset classes, strategies, and managers is important because it allows you to, again, create a beautiful risk-adjusted portfolio that should produce higher returns for you. And you can see that $1 invested all the way back into 1970, if that had been invested in just U.S. stocks, you would have lost out. You would have had a much lower ending value versus $1 invested in 1970 in a global portfolio, a much higher value. So with that, let's go ahead and keep on going because I think that you're talking about international is really important, and we want to talk a little bit more about what might happen based on different types of recoveries. Currently, we have close to a full strategic weighting in developed international stocks. And this is actually because our expected returns for international stocks relative to the U.S. stocks are actually higher across pretty much all of our scenarios, having similar downside risk to owning U.S. stocks. We like international stocks, particularly European stocks, for a few reasons. Number one, European companies are currently under earnings relative to their normalized earning power. So that means that the price to earnings versus their normalized earning power is lower, giving them potential for more earnings growth. Second, European stocks are trading at pretty attractive valuations overall. And third, this comes from a lot of our conversations that we're having with international equity managers, essentially saying that European companies have gone through a tremendous amount of restructuring. They've dramatically cut costs and increased their operating leverage. And most recently, I'm sure you've seen in the news, Europe has come forward to talk about their stance, their commitment to additional support for the economy, the markets, and they are starting a whole round of quantitative easing. The market actually responded to that very positively, and we saw actually last week international European stocks in particular up significantly. And we expect that this trend, while it will be very volatile, we expect that over the next 5-year horizon that international stocks, particularly European stocks, will do well. This chart shows you our expected returns for a bearish scenario, our base case current scenario that we expect going forward, as well as a bullish scenario, a case we would love to believe is going to happen. In all of those cases, you can see that U.S. large companies, as well as developed international, particularly Europe, even in the bearish case, has a pretty similar return. However, in the base case and the bullish scenario, you can see this is when the developed international European stocks really start to outperform U.S. large company stocks. That's where we expect to be, is in the base case scenario, and we'd love to believe in that bullish case scenario, but we need to see a little bit more positive economic news from the economy before we're really convinced of that. So with that, we're going to go ahead and get started and talk a little bit more about emerging market stocks. So emerging market stocks offer higher return potential than U.S., definitely, but unfortunately, there could be some greater short-term downside risk. We could see a lot more volatility in the near term. Emerging markets have continued to face some very strong short-term headwinds. For example, we've seen the slowdown of growth in China to essentially be more in line with slower growing countries. Unfortunately, the good news is that these recent events have not necessarily undermined the longer-term positive investment thesis for the emerging markets, because there's a lot of opportunity there. In fact, there are great quality active managers that we know can add a lot of value in this region by being able to choose the right countries and also the right companies to invest in. Now, we also included a chart for you to see how we expect U.S. stocks to perform, and you've seen these numbers before in that previous chart, compared, however, to emerging markets. What's interesting in this scenario, that in both the bearish, base case, and bullish scenario, emerging markets absolutely trounce the expected returns that are expected to be produced from U.S. stock market. So while we do expect that there is going to be continued volatility, definitely more risk in owning emerging markets, we feel very confident that over the long run, and that is that 5-year time horizon, that it makes sense to have this additional diversification, to have this additional exposure specifically to emerging markets. Overall, 2014 was a difficult year, particularly for active managers. Active managers, if you take a look at the different indexes compared to active managers did not do as well as many of the indexes last year. There's a few reasons. First is that it's been a very narrow market. The returns have been driven by the largest of the largest companies. Those are the companies that have generated the strongest performance. also, we see that many of the large cap managers have exposure to U.S. companies that also have international operations. So they are classified as U.S. companies. However, because of their global scope, they too were impacted by the weak international economies. And then finally, active managers, particularly valuation-sensitive managers, they've been holding cash. They have had the same concerns as we have. When you look at the numbers, you look at the history, the positive, robust, strong bull market that we've had, we know that it can't continue forever. However, we know that having only active mutual fund managers is not diversified in itself either. So we have quite a bit of exposure to indexes in our portfolio. However, right now we are doing a tremendous amount of research into adding more exposure to market indexes over the long term for clients. Let me show you some of the interesting options that we're looking at as we go forward into our portfolio positioning. So as we think about that exposure, we think about how can we continue to protect our clients in each of these scenarios. The bull case, that is essentially where we would hope to be. We look at the bull case as something where it's our optimistic case. And this recognizes the potential of a above average gross domestic product or growth, earnings growth. Whereas previously our bull case was returned to just average growth. We also assume the Fed starts to exit its accommodative policy without a major market or economic disruption. We see that a normal business cycle type of recession, however, within the next 5 years. So this optimistic case is essentially, it's a growth of above average growth of the U.S. economy. This is not something that we see as extremely likely. Instead, we see more so of a base case occurring. In our base case, the moderate economic recovery continues, though we may encounter also a normal cyclical recession at some point in the next 5 years. We assume that a return to much more normal inflation around the Fed's target, and that the Fed slowly raises interest rates going forward. So now, the bear case, the one that we all hope never occurs, is essentially a case assuming another severe recession, similar to the financial crisis. However, I will tell you that over the last 12 to 18 months, the scenario has steadily declined in importance as the private sector has continued to deleverage, and we've removed it really from our formal scenario framework. This is essentially a fancy way of saying that the bear case scenario is a case that we do not expect to happen, and the evidence for it ever occurring has continued to whittle away to be really not substantial at all. As far as returns, you see all these different asset classes here on the right: U.S. equities, developed international, particularly Europe, emerging markets, real estate investment trusts, REITs. We have then our fixed income, our bonds, our investment-grade bonds, high-yield bonds, floating-rate bonds, Treasury inflation-protected securities, also known as TIPS. We've included estimated returns, average annual returns over the next 5 years for you in each one of these scenarios. You'll see in the middle, of course, is highlighted our base case. Our base case assumes for U.S. equities returns of not too exciting, 2.3% for U.S. equities, 11.2% each year for Europe, 7.7% all the way upwards to 13.4% of emerging markets. And the large range there, the large range is 100% because of the volatility and the additional risk that emerging markets is posing to our scenarios. It's partially because of the uncertainty with China. It's also because of the U.S. dollar increasing in value. All of those things have definitely a headwind to emerging market communities. As we continue down, you'll see more exposure to, however, bonds. Bonds, we expect it to be a relatively good next 5 years. However, more so for bonds such as high-yield bonds and floating-rate loans. We have a good amount of exposure to high-yield bonds through some of our bond holdings that we have, Osterweiss, as well as a few others. And then floating rate loans. We have actually direct exposure to floating rate loans through a few of the funds we own. And so these are areas that we see a lot of opportunity and are very excited about over the next couple years. So do bonds offer the same types of returns that we expect going forward that we've seen in the past? I wanted to show you here, we put together this chart. And this chart shows you during times where we saw severe recession or a severe downturn, how did bonds perform? So going back to August 81 through August 82, a period where we saw the SP 500 go down, fall by over 23%. During that time period, the Barclay Aggregate Bond Index returned 23%. Pretty nice. Whereas the 10-year Treasury, 14.4%. When you look at 2000 to 2002, a time period when the S&P 500 lost more than 22%, you also saw some nice returns too. The Barclay Aggregate Bond Index returned a 10.6% return, and the 10-year Treasury had a 6.4%. Now below that, then we see 2007 through 2009, bonds did fairly well. During this time period, I'm sure we all remember it, the S&P 500 had a 40% loss. Our concern is that because we are in such a low yield environment, core bonds do not necessarily offer the same historical level of downside protection that we saw here. That's part of the reason also why diversification is so important. Diversification so that we have both international exposure, domestic exposure, and then also even within bonds, diversification between high yield, floating rate, treasury, as well as intermediate term bonds, core bonds as well. Our bond positioning favors higher yields, lower risk. Our biggest concern is the concern of rising rates. As rates rise, as we all know, bond prices go down, and that's just a fancy way of saying that you lose money. Moving on to our fixed income allocation, the thing I really want to point out to you, essentially the most noteworthy development of our last year was the removal of 2 PIMCO funds in late September and our very recent addition of the Guggenheim Macro Opportunities Fund. It's primarily an unconstrained bond fund, allowing the manager to have more flexibility in the types of bonds that are invested in. And essentially from an asset class perspective, investment-grade bonds are likely to generate only very low single-digit returns over the next 5 years. And our very low return estimates are explained by the very low current yields and our expectations that interest rates are going to move higher in this time frame. Essentially, interest rates have continued to trend lower, actually for the last 3+ decades, providing a tailwind for bond returns. That's why we've seen a lot of nice bond returns over this time period. But again, looking ahead over the multi-year investment horizon, we do think that higher rates are likely. Over the timing and the magnitude, of course, are somewhat uncertain. We can't help but note, but 2013, we were often asked by clients why we didn't own core bonds, given their lousy performance when interest rates rise, which they did last year. We gave the same answer: risk management, diversification, and not necessarily knowing the timing of interest rate increases. In 2014, when core bonds beat all of this other fixed income structures, sectors, we stopped getting the question. So again, we see the benefits of diversification overall. Almost half of our fixed income exposure is in opportunistic, flexible, and absolute return-oriented funds that we believe will have superior long-term risk and reward profiles compared to core bonds. Although we know that there's high credit risk and a less short-term return potential than core bonds if rates continue to drop. I wanted to talk a little bit more about in our fixed income, the additional fund that we have added. It's a great investment that we're very happy about. The Guggenheim Macro Opportunities is essentially a go-anywhere fund that focuses on bottom-up fundamental credit research. It's a benchmark agnostic with no constraints to duration, sector, issuer, or credit quality. This allows the manager to have more flexibility in making sure that they are invested in the right bonds that will not be impacted by interest rates rising. Essentially, the Guggenheim Macro Opportunities, it plays in the same space as the PIMCO Unconstrained Bond Fund. And again, it gives us a lot of flexibility of exposure to many different types of bonds. We like this. This is very important to us, especially in a time, as I mentioned, when we expect interest rates to rise. Essentially, Francis Financial, our researcher partners, also Lippman Gregory, that we've worked with for a decade, did quite extensive due diligence with this team. Guggenheim was visited here in New York numerous times by Lippman Gregory, as well as out to their offices in Santa Monica, California. So we've been very happy in talking with them. We see that they have a very sharp focus on risk management through diversification, modeling, stress testing, and also having very clear loss thresholds. As I mentioned before, we spoke a little bit about adding additional index exposure to our portfolios. We are looking in are in the research process for other interesting areas, interesting investments. Essentially, we are evaluating funds that are backed by a huge amount of great data, really good long-term performance, that are very diversified, cost-effective, and have disciplined approaches. These funds that we are looking into is the Vanguard Growth Index, the Vanguard Large Cap Index, and also DFA U.S. Large Cap Company and DFA U.S. Large Cap Value. The DFA funds, just so you know, you have to be a financial advisor, a registered investment advisor, and have gone through extremely rigorous, for us it was a year-long process of being evaluated and reviewed to be able to actually offer these investments. And Francis Financial is very proud that we have been selected as one of the few advisors that can offer these investments to our clients. So as we continue to research this and finding out, the best ways that we can potentially implement this going forward, and if that actually is something that we should be doing, we will definitely keep you in the know as we continue down that path. So I think we can all agree that this time is a very volatile time for 2015 and going forward. We invite you, please reach out to us with any questions you might have. If you would like a copy of this, we will have this posted to our website so that you can listen to this again. This is obviously a very technical conversation, and we, in talking with clients, typically explain this information in a little, I would say, even more user-friendly way. But for those of you that want the details, want all of the technical information, we really are committed to this investment forecast, and we do this every quarter. Again, we invite you to reach out to us, and our website is www.francisfinancial.com. You can also reach out to me. Please reach out to me at Stacy, S-T-A-C-Y, at francisfinancial.com as well. I'm wishing you a Happy New Year. Thank you for your confidence, and we'll be in touch with you soon.